That works most of the time. Thanks all for joining us for this terrific panel we have this afternoon. And thanks for the Clearinghouse and to Panelists too for hosting us here today. As we've done for each year when we do this, we have a terrific panel of CEOs. Together, I think they represent what seems like half the banking industry, so it's quite a group today. I'm Fritz Now with McKinsey. I have the privilege of moderating our session this afternoon. I think we'll just start because you may not all know each of the CEOs and just ask each of them to do a quick introduction of themselves and their bank before we get into a couple interesting topics. Kelly, maybe we'll start with you.
I'll start. My name is Kelly Coffey. I'm the CEO of City National Bank, which is headquartered in Los Angeles, where it doesn't rain. And we are 100% owned by World Bank Canada. I've been CEO since the beginning of 2019, February, after about 30 plus years at JP Morgan, where my last job was running the U.S. private bank.
I'm Brian Moynihan, the CEO of Bank of America.
I'm Bill Rogers, Chairman and CEO of Truist.
I'm René Jones, Chairman and CEO of Energy Bank.
Bruce Van Saun, Chairman and CEO of Citizens Financial Group.
Great. Thank you all. Thank you. We'll start with a little discussion on the macroeconomic environment, and I'll refresh us. Back when we were here last in November 2019, it was obviously pre-COVID. Geopolitical issues were a much lower concern. Inflation wasn't really a topic, so a lot has changed. And Brian, given your purview of what you see, maybe we kick off with you in terms of what you're seeing in the macroeconomic environment.
Like a lot of people out there, I'm sure I can't remember what 2019 was like to compare it to now. So the reality was, as you quickly summarized, that we were sort of the longest recovery ever. At the end of the recovery, the debate was, how come there was no inflation? But if you come forward 3 years, the debate is about inflation. And will the Fed, how high will the Fed have to go? But let me just give you the stats we see, which is probably more interesting than to talk about others' economic projections. Our team does have 5 quarters of negative growth projected to all 4 this year and 1 next year. And so they're not out there, but it's a modest negative growth each quarter, and then returns to trend the end of next year. What do we see today? Through the month of August, the consumers of Bank of America, which is 60 million households in the aggregate, 35 million core checking customer households, spent 10% more in August 2022 than they spent in August 2021. And that's continued to be the same pace they've been doing it all year. So 1, they are spending. 2, you saw a slight movement down in their accounts from July to August to a level which is in excess of where it was in March and April. March before the tax returns come in. So again, what happens is in March, accounts were coming up every month. In March, they shot up for tax returns, they came down, people spent, they started building. And then my guess is with some vacations back to school, you saw some deterioration. But to give you a perspective, for a customer who had $2,000, $5,000 in their bank account in pre-pandemic, their average is $3,400. They have $13,000 in that account today. And at $13,700, and it went at a peak, it was $13,900. So the customers have a lot more. If you go to the next bracket above that, 5,000 to 10,000, the numbers are just as stark. If you go to the bracket below that, it's even more stark, $1,400 to $7,000 plus. So consumers have money in their accounts, and nothing going on that's broken them. And then they have the ability to borrow, and I'll let some of my colleagues talk about the commercial side. But on the consumer side, the home equity is up. And so they have the capacity to borrow. Credit card came down dramatically or started to come back up a little bit, but still plenty of capacity on the lines. And then auto and stuff is freely available. The rate structure's up, that slowed down activity in mortgage, but that's what's supposed to happen. And that's what the Fed is trying to achieve, is a slowdown in house price appreciation as part of their economic adjustment. And so you're seeing all that take hold. But the good news is the toughest news for the Fed is the good news for America. America has a big consumer-led economy. Those consumers have money, they spend, and that makes the Fed's job tougher because we're trying to slow down a pretty good-sized juggernaut. I'll turn it over to others to talk about the commercial side.
Great. Thank you, Brian. Bill, maybe you jump in on commercial and corporate?
Yeah, sure. Just maybe to build on a little bit Brian said, though, It's also just hard to start, where's the reference point? Is it pre-pandemic, is it, where all this? And I think sort of if you just look at the whole outlook, the consumer and business are in good shape. So we equally think there's some, a bump in the road ahead. But we enter this with consumers have a lot of cash, their personal balance sheets are in good shape. They're feeling the effects, certainly at certain ends of the spectrum, feeling the effects of inflation more than others. And then on the commercial and corporate side, I mean, businesses sort of never been in better health. The company's balance sheets are all really strong. Most took advantage of either the high yield or high grade investment markets, and were able to refinance and put a lot of length on the credit. We're all starting to see a little utilization of the revolver side. I think that's sort of a natural evolution of where you are in this cycle. Businesses are generally good. When we talk to clients, that it's not usually a demand issue. It's usually a supply issue and labor issue and margin issues and inflation versus necessarily a demand issue. So, again, overall, I think on the commercial side, a very similar story to the consumer side is we're entering into this with a good deal of health. And from a credit perspective, if you look at all of our respective, credit statistics on our commercial class, they all are pretty healthy right now.
Great. Maybe, Kelly, if we transition to you, California being about 15% of the U.S. economy, and you've got a strong focus there. If you talk about what you see in California, especially maybe with your small business clients.
Yeah, definitely. I think we're seeing similar trends as to what Bill just mentioned. First of all, California on the data still looks quite strong. I mean, it's outpacing growth in the U.S., definitely getting impacted by what's going on here. But if you look at unemployment, it's still quite low. We still haven't seen housing prices back off where they need to be. A little bit of softness in some rents in Southern California, and housing affordability is the lowest it's been in a very, very long time. So we're still seeing pretty strong trends. A couple things that might be interesting. I'd say on the small to middle business, which is where we focus. Still a good demand for credit, and our utilization rates are pretty stable year over year. So we're still seeing that demand. I'd say our clients, every time you talk to them, I was with a group last week, clearly very concerned about inflation, definitely concerned about labor, both the cost and availability. We have a franchise finance business, and I think it's gotten a lot of national press too. California just passed a law that there's going to be a state board that's going to oversee compensation or minimum wage for franchise employees, which has gotten them pretty concerned, particularly given the number of clients that own 1, 2, 3, and it's a pretty diverse owner. But that's I'd say if I'm concerned about anything in California, it's one of the hardest places I think to do business, given the amount of regulation. But I still think doing well. The port is there's still a little problem on the rail side. The trucking side is not as long delays, so we don't have as many ships hanging out off the coast trying to get in and deliver. So that has eased a bit. So the supply chain pressure feels like it's coming off. And then the other thing, we spend a lot of time in entertainment on the West Coast, and LA is obviously a key center for that. So is California with a lot of tax credits. And the entertainment industry is always changing and it's always adapting. I'm sure you're reading a lot of press about that and what's going on with Netflix and some things being canceled. But I'll tell you, you can't find a soundstage in LA. There's not a lot of occupancy right now. Now that's a little bit backward looking because you're booking for things that were green-lighted before. But still, I'd say, still seeing strong demand for content across TV and film. I would say live touring's back in a real way. If you look at Live Nation and what they're booking and what we're seeing with our clients, very, very strong demand for that. And Broadway not back to pre-pandemic levels. We bank more than half of Broadway, but holding steady. So we probably need a little bit more tourism to come back to the U.S. That's usually about 65% tourists that go to Broadway shows. So it's a little bit of what we're seeing.
Great, thank you, Kelly. Bruce, maybe what do you see in terms of your franchise on the consumer side or broadly?
I would agree basically with what Brian and Bill said. The consumer's in a very strong position, and companies are also weathered the pandemic well and changed their business models and are having good years generally. On the consumer side, the amount of liquidity in the accounts is very, very high. Combination of the kind of government transfer payments and forced savings during the pandemic, and then the employment picture is very strong as well. So when we look at all our credit statistics, delinquency, roll rates, NPAs, charge-offs, very much below where we were pre-pandemic, and I would say it's going to take a long time to normalize back to where we were. And then in terms of loan demand, what's interesting, home equity line of credit is taking off, and it's been in the doldrums for years. So that's something very noteworthy. In addition, I think revolving credit is ticking up a little bit gradually, which is good. But categories like mortgage and student and auto are pretty moderate at this point.
Great. Thank you, Bruce. So overall, I'm hearing, while a lot of changes, the balance sheets so far are holding up, obviously. So maybe we'll switch then to innovation and how customer needs are evolving. And René, I'd like to start with you maybe on in terms of what you're seeing with your commercial clients and how their needs changing and how are you innovating.
Sure, Chris. I guess if you step back and think about it, over the last decade, most of us as banks have actually made our investments in innovation have been on our own value chain. So essentially trying to make our value proposition better for our commercial customers, taking the pain out of the system. So that could be faster payments, removing frictions. It could be trying to shift to digital to lower the cost to serve. But as you kind of move to where we are today, and I think to Bruce's point, somewhat influenced by the pandemic, we're much more in a space where our commercial customers are looking to us to help them add value to their customers. And that's sort of a different proposition. If you think of a couple of examples, if you think of like merchant services, it was originally designed as a really pure process payment. Now you're seeing those platforms actually become platforms where they're helping with payroll, they're helping with inventory management, and things that will improve the value of their businesses. I think when I think of what's coming up, I think of ESG, for example. If you're a commercial customer with a commercial property here in New York City, you're going to be asked to meet certain standards around energy efficiency, around emissions, and those types of things. And if you don't comply, you're going to get stiff penalties. On the flip side, if you're more proactive, you might actually have revenue streams that are coming. And so those clients are looking to us to actually help them understand how climate is going to work, how ESG is going to work, and how do we get integrated into the capital stack, where those issues are going to sit. And so it's a much more proactive engagement with our customers and better partnerships. I think on the ESG thing, I think I'll just say this, Brian, I think your team has really led in that space and sort of taken that posture that it's not necessarily a compliance exercise, but it's a way in which we can add value to our customers. I think the other thing that's important is what has not changed. And I'd say if you look at business surveys today, 68% of business owners still like to go make their deposit in person. 83% like to close their loan docs in person. And so some of that, as much as we think about all the change that's happening, it's behavioral as well, and it takes time for those patterns to change. So we're having to do lots of things that are driving a high demand for human connection, right? Again, coming out of the pandemic, I think there's a trend there that we have to watch. And then finally, what I'd say is no matter what we're working on, it's safety and risk management that they're asking us about, asking us to help them with their processes there.
Thank you, René. Great examples. Let's shift to the consumer a bit. Obviously, the industry has focused a lot on, from a payments perspective, how do you provide convenience, low cost, security, and Brian, maybe over to you on how are you seeing the industry develop the solutions and innovating on behalf of consumers in payments?
I think, go to sort of why we're here with CPI and Clearinghouse. Our job is to drive faster, least cost, most assured, most trustworthy payments across all these dimensions. And you're doing that, as René said, on top of hugely scaled platforms. I mean, writing a check is not exactly something that preoccupies the consumer's mind is that is this going to work or not? And they write the check and send it in. So, or using a Visa or MasterCard, stick it in the machine, they go anywhere in the world, they hand them this piece of plastic, and out comes a meal. Pretty nice thing. So you're trying to improve these things that are quite substantial. So I think a lot of our work is about how we as an industry can drive our collective ability to accelerate the transformation to really no cost, in the grand scheme, as low cost as we can in funds. And so whether it's real time, whether it's Zelle, whether it's the work that EWS originally did, all these just ways that we can keep driving and address those core issues. And I think the issues that we're after next, so to speak, away from the issues that are there, are around, obviously P2P, the industry's come together and driven a solution there that's effective, very, very important. But wallets, international small balance payments, these are things through the real-time connectivity we now have, through connecting that around the world, through the verification of the fact that a Bank of America customer transacting with a Santander customer in Spain, we have two banking systems with heavy regulation, knowing those customers, doing all the work, allowing that to move quickly. These are wonderful things. So I think as we think about it, it's doing it, the challenge is we're doing everything for everybody with every different form of payment. That statistic I gave you before, across all these different ways that money moves. Some grow faster and some go slower. But on the other hand, we have to be leaders in innovation. I think with Zelle we proved that. I think we could prove that with real time. I think we could prove that connecting real time around the world. I think then the fraud and other things that we're working on heavy are really important. But that's where we're going, and the consumer will follow to the extent it's easier, and the extent they don't have to think about it, and the extent they don't have to worry about it. And that's what we've all learned, and I think that's what we're trying.
Thank you, Brian. Curious if anyone else wants to add on that or build on that, obviously in terms of your bank, what you're seeing on the consumer front.
On the commercial, on the corporate side, yeah. So just to put together what René was saying, what Brian was saying, I mean, I think the commercial client has just much higher expectations of us and the role that we're supposed to play and the place that we come and helping them become more efficient, helping them get more revenues, helping their supply chain dynamics. I mean, we're playing a really different role, and I think the payment system just has an incredible place for that. So not only on the consumer side, but with all the digitization that's gone on, the bulk, 2/3 plus of payments made by companies are on paper. So with all this that's gone on, there's still this great opportunity, and real-time payments has an opportunity not only to create all the things Brian talked about, safety and security, but just actually putting all that together and making it an electronic transaction like everything else they did. Would be able to invoice and do all that through real-time payments is just a huge advantage for from the small business to the largest corporation. And then the same concepts of cross-border payments, the things that we're doing in the TCH to create cross-border, all the safety and security, you talked about that. And then I think the next frontier is the concepts of tokenization, so creating that extra level of security with tokenization. So even if you're sort of not adopting some of the others, you may want to say, okay, well, we actually want to tokenize this information, and then we can share it across clients, all creating more efficiency, more safety, more security, so all the things that René just talked about in terms of what our clients expect from us. So I think we're making really incredible, important frontiers and important developments for our commercial, again, all the way small business to large clients.
Thank you, Ben. Kelly, maybe back to you. How do you think about City National innovating on behalf of your customers? You talked about some of the challenges in the entertainment industry and more broadly before.
Entertainment's a good example, and I think it goes back to both what René and Bill said. All of our clients are under tremendous pressure to be more efficient, whether it's they can't get the right labor or they're under pressure from some other way. So the approach we've taken is to innovate around their pain points, particularly when you think about payments. So entertainment's another great example of so many entertainers are getting these little checks for $1, $2, whatever they are. So we have bought a couple of fintechs over the years that are both the accounting system for big chunks of the entertainment industry, and then the firms who basically calculate who owes what to whom, because it's all royalties, rights management, which is pretty complicated. And so partnership, for example, with SAG-AFTRA to digitize all of those payments is something we've been very, very focused on. When you think about every entertainer is a business in themselves. They're a brand. They don't get up and go to the same place to work every day. They're going to work on a project, et cetera. So they each have their own CFO who needs an accounting system, which is what we do. And then many times we're just moving money through City National from this production company to that. But it's how you track that and making sure everything from when you go on a tour that we can give you a card that's going to only authorize them to do what they do, real-time upload what's being spent on the road, turn off when it's supposed to turn off. I think these innovations that have been made across the banking industry are all geared to making our clients' businesses, their lives easier and more efficient. So we tend to co-create. You get a group that's very into, I want, every piece of feedback is a gift, right? I want it to do this, and then we get it to do that, and the key is prioritizing them. So that's the approach we take with innovation on the digital side.
Bruce, maybe over to you. What have you and at Citizens learned and experiences you've had, maybe overall in innovation, and also to the extent you've partnered with fintechs?
Sure. So obviously, innovating is essential to keeping a strong franchise, and so we focus on it in a number of ways. I think everything my peers said about you focus on customers, customer needs, and improving customer experience. That's the root of it. You have to train your thinking that way. But we focus on some big picture sessions, top down, and then we also have collection vehicles to get full participation from our colleagues, where we have an innovation fund. We have a Shark Tank process to take those ideas and then accelerate them and trying to get them to market. So inside the company, that's had some big successes for us. We've had innovation around point-of-sale finance with our partnership with Apple, which we turned into Citizens Pay. We had student loan refinancing. We were early players there. We were early into our national digital bank with Citizens Access. We've just most recently focused on the home equity line of credit, since it is an area that's coming back in vogue. How do we improve the customer experience? Over a third of our HELOCs now are getting done in under 20 days, when the industry standard for origination is 45 days. So we're using data and analytics to make that whole process easier. The other side of it is, it's good if you can do it on your own, but then the fintechs are really have great innovation around customer needs and customer experience. So we have a team that's surveilling that all the way from setting up hackathons to solve specific problems, to looking at early stage fintechs and then more mature fintechs. And we currently have over 25 fintech partnerships that are pretty impactful in terms of how we're serving our customers. So it's a combination of what you do internally, marrying that to capture the great innovation that's happening in fintech land. But again, it's always focused on delivering for customers and solving customer issues.
Great. Thank you, Bruce. And just a quick reminder to the audience, as you have in some previous panels, if you enter questions, we may have room for some of those at the end. We're going to transition then to talent and workforce. Obviously, the requirements from the workforce in banking have continued to evolve, and quite frankly, we've seen the needs or desires of teammates and employees change as well, especially through COVID. And I'd like each of you, and Kelly, I'll start with you and maybe go down the line, to talk about how you're thinking about talent, culture, workforce, and what you're doing in that realm.
It's the biggest question of the day, because the most value we have are people, which we used to say walk in and out the door every night, but now they don't actually walk in and out the door every night as much as we'd like them to. So the approach I've taken, or we've taken at City National, has been one of, setting some expectations, which we were pretty flexible on in terms of where they were. Particularly, during the pandemic, there were moments of time where we're about 6,000 people. Just given how busy we were with some of the things, we couldn't afford to lose a lot of people at once. When mortgages booming, everything. But we were pretty clear on expectations. But I let that happen at a divisional level. We're about to pull that a little bit more together and be a bit stronger, because I think flexibility is important. I think hybrid is in some ways here to stay. Although if you look at pre-pandemic, we were just talking about this before, I went back to look at the data, we had about 60% of our people in the building on any given day. So I feel a little bit like a fool of always getting more real estate when we were growing, because we don't have to do that. They're not coming in every day. And so I do think we can turn this, if done right, into a competitive advantage, particularly as the the war for talent is so extreme. We've done a number of things to hire, we're just up and down the coast, so hiring out of our footprint has helped us a lot in many parts of the business. But I do think it's long-term damaging to culture and innovation to not be together. And so the approach I'm taking is one of, we tend to be a pretty purpose-driven organization. And we talk about clients, we talk about colleagues, we talk about communities. And the approach I'm taking is you are part of this team and you owe it to the team to be there in person. And the office is just the easiest place to do that, to be with one another for some bare minimum amount of time. I think people tend to define that as days. I'm trying to find a different way to define that, but more than not, call it 3+ days in the office. So I think that's important. The second thing I would say is that I think we have to be even more programmatic about culture than we've been in the past. You have to really be deliberate about when you're bringing people together, why you're bringing people together. I think communication is really important, and finding lots of ways to do that. I started a podcast in the pandemic that I did weekly, like 10 to 15 minutes with me, and then pull somebody in, and now I'm starting to get other people to host, so I'm not doing that every week. But I do find that that's going to be the challenge, and so how we do that is going to be really important. I am concerned about keeping that purpose, because if people aren't spending time together, they don't feel it's connected to you and the company. And I think for junior, I would hate to be starting today. It's a very hard time. When I think about all the opportunities I got because I was sitting next to someone that helped me or managed to reach out to someone. So I think we're going to have to be, we're being very purposeful in how we're defining that. We're doing a lot of different pilots and things about how the office should be structured, and it'll be different based on the different jobs, but it's challenging, I would say.
Thank you. Brian?
Well, so we basically went at this sort of series one that we just started bringing people back, inviting back, and let that sort of take its natural course. And we have 210,000 people, and it's really 210,000 different views of what people want. And so you can't, so you can't generalize, and so I finally, after listening to people go back and forth, I said, we need to go at this like you go after any other business problem, and let's start. We surveyed everybody, 190,000 surveys came in, asked them a series of questions of what flexibility meant to them, what they did. Do they want, is a commute length, commute length this length versus that length? So we have all this data, which goes to every location, every person. You go down to all over the place. And then we just started sort of Six Sigma process, and we're sort of a step in the process where you're transforming from could to should. Could you do it? The answer is yes, there's a lot of jobs you could do it this way, but should you do it? And that's where you lay on the constraints. We're a regulated industry. We have lots of customer data. We have T1 connectivity of types that are the size of huge environments in these centralized environments. How does that work at a house? A set of work rules in different states. Your state being one that's adopted a distinct set of rules about it. You've got tens of thousands of people there. You've got all that, and then you have culture and process and everything. So what we said is let's let the process go out and get the feedback from everybody and percolate what they do, and how to develop a set of rules and try to aggregate it together. But we'll have more flexibility than we did on paper before. And I didn't say on paper because we are only about 10 percentage points different from where we were pre-pandemic to now, and actually in office attendance on a given day. But we'll have more formality to the flexibility because we have to, because otherwise it would be subject to a lot of different interpretations. And we need to make it consistent and fair across units. So if you have mortgage underwriting from the people who make the mortgages, process the mortgages, and then ultimately service the mortgages, if they're in all different conditions, it's going to be an interesting thing when they're trying to come together to deliver a process. So you have to think about that horizontally through the company. So we're in the middle of this, and we've sort of let it play out. Buildings are full and active, and we'll see how it all plays out. But it really will be down to every job, every rule, and then rolling that across groups, and then across the company, and fairness and culture and all those things. And then we'll play it out. In the next 6 to 8 weeks, we'll have sort of a set of standards, and they will be standards for today, because they may change in the future, because nobody knows what's going to happen.
So, Brian, we actually, through our Leadership Institute, did some academic research on your 210,000 reasons, and it was verified that, there were, for every person, there's a different reason, which actually is sort of an important potential thing for all of us to remember. At Truist, for us, everything begins and ends with purpose. So we really start with our purpose to inspire and build better lives and communities. This environment for us is more reason to be confirming of that as our North Star. We ask all of our teammates to talk about their own personal purpose. How does their purpose connect to the company's purpose? And what is the meaning of all that? We had a conference to set up for this out of my conference room, which is called the Happiness Conference Room. They all made fun of me, so just to acknowledge that.
Is that right next to your office?
Exactly.
It's the one down the hall worried about them.
Exactly.
We like it.
But our value of happiness is the highest correlation to happiness is doing purposeful work. So for us, it's just to remind all of our teammates, before we get into the debate about should you be in 3 days, 4, whatever it is actually the work we do is important. And the work we do is purposeful. And let's make a connection to that to start with. So let's create that as the framework from which we have the discussion. So we do a lot of work reminding ourselves of that. And then I think to parallel what everyone else has said, that this is the mode that we're in is a leadership model, because we're going to be more flexible. I mean, we're already flexible coming in. I mean, I sort of think the concept that we weren't flexible before is sort of a bad theory. We were already flexible, and we'll be flexible under an environment that's just going to require a lot of leaders to make those decisions. And we're doing the same thing everybody else is doing. The non-negotiables are the culture of our company. The non-negotiables are the driving purpose of our company. The non-negotiables are we're going to have mentorship and sponsorship and all apprenticeship and all the things that are important to building a culture. But how we do that could vary pretty substantially within an individual business unit, and that's going to have a lot of dependency on leaders. So we're spending a lot of time going back and retraining our leaders about what it means to be a leader and what it means to make those decisions, because the top-down, here's one way, is just this is not going to work in this environment. So, for us, purpose and it's a leadership model. It's just confirming that.
Thank you.
So for us, we have this belief that basically says that if you go through a lot of competitive change, the only enduring thing is going to be the teams that you build and the environments that you create for them. And we've had that for some time, but it's never been truer today in this environment. And I wholeheartedly agree with Bill that when we ask people early on to come back into the office or to go somewhere, our response rate was low. But when you ask people to do something for a purpose, the engagement is, goes through the roof, right? And it doesn't matter whether they have to be better together or whether that particular thing allows them to be separate. So I think we're relearning everything based on that lens. But one of the things that we focused on is we've now done an employee survey, like I'm sure many of my peers have done. We've done it for 23 years. But what we had never done before is connected it to the work we do on CX. And you hear all these surveys about if your employees are happy, then your stock price goes up. It's all a lot of nonsense until you think about it in really simple terms. And if you think about it like an ice cream shop in your neighborhood, the customer's really happy when they get the ice cream and they get it really quick. And they're not happy when the line's really long. And your lines are usually long when your employees don't show up for work.
The ice cream's got to be pretty good, too.
It's got to be pretty good ice cream. But you can't get it if they don't show up for work. So, it's not all that complicated in a way, but we had never really kind of focused on the two things together. And so we're really renewing, which I think it's really a sense of purpose that we're renewing, of, what are we doing and are we listening enough to those employees who are closest to our customers, who are actually engaging? And then it brings you all the way back to this idea that our customers want to be together. They want more human interaction. So that's driving a lot of how we're thinking about talent. But the one other thing I would say is that, and it's more of a statement, when I was joining banking, there are about four degrees that you could have to come into a bank. And now we're hiring anthropologists to get at what Bruce is talking about on customer experience and behavior. You can pretty much major in almost anything today and be relevant to the bank. And I think that's an amazing change that's happened in our industry. I think it's going to be, we'll be better off for it.
Bruce? Last but not least, again. Anyway, I would say I concur with what my peers have said, but Bill's point on purpose and just making sure, like, our mission, vision, values statement is our North Star, and that's something that we want everybody in the bank to internalize and realize that banking is a noble profession. You help people in your day job, and then you have a platform to volunteer and help them again in your spare time. So that's been really big for us. It's interesting, in the war for talent, who will be successful? And we focus really on three things. One is having great leaders, so making sure we recruit strong leaders into the company or build them internally. We have a lot of investment in programs to help develop our leaders. We have a leadership profile we want folks to fit. Culture is the second big thing, is making sure we have a strong culture that is very collaborative and focused on the customer and impacts communities favorably. And then the third thing is just attracting talent and investing in your own talent and giving them opportunities to grow and move up the ladder inside the company. We set a target a while back to move the number of open slots filled internally. I think we were in the mid-20s, and best in class is low 40s. I think we're getting up towards 40%. And that makes a difference when people see other people getting promoted inside the company. So those things all make a difference in the war for talent. And the last thing is just talking about all the innovative, good stuff that's happening in the bank. When people think you're playing offense and you're investing in the latest technologies, folks from outside want part of that action. We're seeing, I think, a return from folks maybe who looked at technology careers as very interesting. They can do a lot of that now right inside banking and really have some great careers for themselves.
Thanks, Bruce. And just a reminder to enter any questions. We're going to do our last round of questions up here, and then I've got some that have come in already. Bruce, kicking off with you this time.
That wasn't a dig, but it's a remark.
As you look ahead to 2023, as we hit the fall here and next year, what do you think of the greatest opportunity and then the greatest potential risk?
Yeah. For us, I'll just answer that for Citizens, but I think the greatest opportunity is if we could get a little less volatility in the capital markets and just some calm, because there is a ton of business ready to be done. Our pipelines are huge, and we've, over time, built out a lot of capabilities and the coverage working really well with our product groups. And so I think there's a motherload of business to come, but we need the markets to cooperate a little bit. And then I'd say just on the biggest risk, obviously it's the macro. So are we able to go through the next few quarters with just a growth slowdown or a short and shallow recession, or does it end up being a harder recession, which obviously will affect banks' performance?
Thanks, Bruce. René, maybe same question.
Yeah, on the positive side, on the opportunity side, I think that we're going to go through a period, as I said earlier, of increased need for human connections. We're seeing it. We don't quite understand what happened to us with the pandemic, but our clients really want to engage. I can't help but think that that's going to produce, really, really positive results for us all if we lean into that. So that's the most positive. I think Bruce sort of touched on it. It's a time that's really uncertain. I like to think about Paulson going to the Treasury during the crisis and asking for $800 billion, and now we just did 10x that. Put it into the economy. So you're just uncertain about what the outcomes are. Good news is we're all in pretty good shape with our balance sheets and ready to take on any challenge that happens to come. We just don't know what that's going to be.
Yeah, for us, uniquely for Truist, is to actualize the full benefit of our merger. So we've got all these expanded tools and capabilities. People have been in a merger mode, and now they're in a operating mode, and we're making that power shift and being able to do that and provide all the capabilities and advice that we can do for clients that are just expanded by some exponential amount. So just being able to do that and what we call as actualizing our purpose. And then on the risk standpoint, I don't think everybody's talked about it. I mean, the risk is that we have an economy that makes it harder to do that. So that's one risk. And then I think we've got, we can't sit here on a panel like this and not talk about existential risk, things like cyber risk and things that could just, be substantial for one bank or industry or a country or a global existential risk. So, I mean, you just always have to have those, black swans and tails, factored into thinking about it.
So I'd flip it and go, the parade of horribles that you can line up right now is substantial from effectively a situation in Europe, which is just seems to not get better between Russia invasion, between the energy crisis, between the food crisis off that, and then the impacts on all different dimensions around the world, the impacts of the disease which is still with us, and still impacting parts of the world heavily. So you can come up with a parade of horribles. But the flip side is, from our country's perspective, what will play out well, whether times are better than people think or worse than people think or somewhere in between, is this focus we have on responsible growth. We just have to drive the organic growth engine that it's taken 230 years to put together. And it was cranking along, and it's ready to crank it along the same level it was cranking on pre-pandemic. And then that's a heck of an opportunity, but by doing it the right way with the risk, we don't have to worry about recession comes. There's no existential threat to us with that high levels of unemployment. We see that in stress test, liquidity, all the things that you worry about. How do I get this position for? Because of the way we run the company, you're positioned for. And because of the way we don't have to trust ourselves, we get the ability to have others look at it and beat the heck out of us on it too. So I think that's what holds the company together. At the end of the day, it's about the team and about the customers and about making sure that they have the tools, the capability, innovation, everything we talked about to deliver responsible growth. So it sounds like the same answer I gave you 19 or 18 or something. That's the fact, it is, and that's what makes it unique. And then, on the end of the broader thing, our industry, has proven its value in a way in the last 24 to 36 months that is almost hard to fathom. I mean, we're not sitting here talking about deferrals and forgiveness and PPP and all the stuff that we did. And by the way, take care of the core commercial demands of our customers, billions and billions of dollars of loan demand a week. It was a marvelous thing. I think we have to take solace in that as an industry, that we came together and did things that we're asked to do and some things we did on our own to actually really push. It's a pretty interesting place to be in this industry in this day and today, given the uncertain circumstances of the power of these institutions that have managed well and thought about it and gotten whacked over the head a few times and come out of a great crisis a decade plus ago, but have done it in a way that you can look at each other and say, hey, we can push harder now, and we can own this space. We can drive innovation because we know we're not going to get interrupted by dealing with commercial real estate or something like that. It's an interesting time.
And did all that mostly out of the office for local people, so that's pretty incredible. For us from a client standpoint, I just, with our market share, we have opportunity across. So probably the only place we have big market share is entertainment, but there's so much going on across music. We're in sports now, so I just see it across the board. And I think for us as an institution, the other opportunity in terms of what we can do not only for our clients but for ourselves is we're still at the beginning of our journey of how to leverage RBC and the scale of RBC, where it really helps us from an infrastructure. So we have a lot of work to do there. On the risk side, I think it's been said that it's the trickiest macroeconomic environment we've been in a long time. I think we're pretty well prepared to do it, and I probably would put cyber, just the increasing sophistication of the attacks across the top.
Great. Thank you all. We have just a few minutes left, and so I'll touch on a few of the questions from the audience here. There are a couple on the M&A environment and specifically kind of a challenge to getting deals done. and the potential impact on, call it, the industry's health. So I'll throw that jump ball out there. I don't know who wants to start with it, but any views on M&A?
Not relevant.
Right.
I'll speak on their behalf. At the end of the day, this industry, we have more banks today than was needed when you look at all the math and science and compare it to other industries. The power of the American financial system, the size and strength of its institutions, the ability to do what we've all done different ways on things like overdrafts or no overdraft accounts, the different versions we talk about it, the ability for us to provide great pricing is because we can pass along the efficiencies of being big. And big is different for me, it's different for the other people, but everybody has gotten bigger over the last decades. It's consolidated. People have done it recently. And Bill was talking about that. That value that we can deliver back. It's not like we're getting some returns that you can't fathom. We're getting industry standard returns. All that value is created to deliver back to the customers and clients, and that's the thesis. That's what makes this industry, in this country, a major asset that no other country has close. So I think we got to remember that part of that necessary evil is to take out the excess capacity, just like was done in the pharmacy business or the food delivery business, or you pick your things, and we're in the middle of this, and it couldn't be done both. I remember the day where I was standing when the case came, Northeast Bank Corp case. I remember exactly the conference room I was standing in, which sounds pretty nerdy, but when you were a bank M&A lawyer at the time, it was a big deal that you could actually do interstate banking without things. It's only 30-some years. It's not like this has been going on forever. So I think this has to take place, and I think you could ebb and flow and have the great debates, but I think fundamentally you have to let that happen, or else you're not going to get the benefits and services that we do. And so I can't do anything, so I can speak to it, because we're not allowed to do anything, but the rest of these companies all in this room, they need to consolidate to pass through that benefit, and that's the connection we got to get people to make.
Well, maybe I'll speak from the perspective since we did the last big thing.
Okay.
So that's, having done the biggest merger in the last 15 plus years in the industry, and adding a pandemic on top of it just for fun to add that dimension. But I think to Brian's points, and look, our code word all along as a merger is that we wanted to be for something. So we wanted to add additional value to all of our stakeholders as part of the merger. So I think M&A, for all its efficiency and all those kinds, at the core of the banking system, it's to improve what we do, and it's to build better lives in communities the way we express our purpose. But I think everybody's is in a similar type fashion. Is ultimately the objective is to serve our clients and our communities and and create better environments for our teammates as part of a merger. So. And sometimes that gets lost in the translation of branch closures or however we want to define a merger, when its premise is to better serve communities. And that's I think you're just closing, and you've just done a few. That's the premise of merging.
Yeah, I think you got to. One thing's really clear is that if you're thinking about doing M&A in the future, you got to be prepared. You got to work on your own shop. You got to do the work ahead of time, because it will be tougher. I think tech and our products and services are more complex, right? And the world is going to demand more from that combined entity. And if you shoot first and then you'll go try to figure out how you're going to do it later, it's not going to work. It's never going to work. So I would be thinking heavily about my own shop. How does it work? How buttoned down is it, right? And sort of earn your right to go and expand.
I think we're at time that flew by. I want to thank all of you for leading this panel. I appreciate the time.
And ladies and gentlemen, in this room coming up very shortly is the keynote address. Don't leave. The action is just starting to happen a little bit more. Please stay in this room, and we'll get to the keynote address in just a few moments. Thank you.